permanent tax saving strategy. And a lot of these other ones are more so temporary tax saving strategies. So
yeah, we don't want the temporary. We want the permanent.
We want the permanent. Exactly.
We want to get Uncle Sam out of the pocket for good.
Exactly. It's kind of like a strategy you put in place one time, but that will pay you not just this year, but every year you're in business.
So wait, there's residual income and there's residual tax savings.
Let's go. Let's go.
A minute. All right, guys, welcome to Success on Repeat. Welcome to Success on Repeat. Thanks so much for being here. I am downtown Tampa at the JW Marriott again. And I'll tell you what, this has just been such a blessing to connect with other entrepreneurs that are in business to help other entrepreneurs. And so today I am joined by a very special guest, Mr. Charles Hopkins, CPA from Wealth by Taxes. How's it going, bro? Thanks for being here.
Hey, anytime, man. It's going great. Thank you for having me.
Yeah, I'll tell you what, we come to these types of like mastermind events and things like that, and we just get so much energy and focus to try to do it and take it back, and of course always the thing is like, what did I got to take back,
Right.
Take back. And so this year, one of the things for me personally, and I'm glad you're here, is that I have been obviously making residual income, and I own my house and I own the office that we're in, but I'm not like a savvy investor, so to speak, right? I wouldn't say like, hey guys, I'm selling you on my 5 tips to investing in real estate yet. You just wait. But I would say that when it comes to building up a residual base of income and a client base and all that stuff, I mean, I'm not gonna say I'm the GOAT, but I know what I'm doing. I can help people do that, and I can show others. We've proven that model.
Solid.
But here's the problem. I'm getting creamed in taxes.
Yeah.
Right?
Tell me about it.
So I'm telling you about it. So because my income, and this is my understanding, is all earned income from business and wages and everything, even though I have a wife and kids and a mortgage and all this stuff,
right? There
comes a point where you hit a point and then like those deductions go away.
Yeah, you're right.
And so help me out, bro. Tell me the things I need to be thinking about.
Okay, fantastic question. So usually it's kind of like a physician.
Yeah.
Before I give you a prescription, I'm going to ask you a few questions to get a proper diagnosis.
Okay, all right.
And then I can kind of go from there.
Sure.
But one thing I will kind of say is that one thing that most business owners need to do up front is whatever you're doing, make sure you're documenting it. So no matter anything I could recommend to you, you need to be saving receipts of some sort in some way, shape, or form, or have a system or process that's working for you.
Sure.
So that in case the IRS gets curious, that we have some evidence where you can say, hey, these are legitimate deductions and this is why we took it.
So like, for example, I use QuickBooks.
Right.
And daily or weekly, I'm classifying every transaction that comes through all the bank accounts and the credit cards. And so I know, in almost real time where everything went. I'm looking at P&Ls.
Right.
Meaning I know the numbers, right? So I know at least those numbers. Now, what that translates at tax time, you know what I mean? That's
another story.
But it's a good word. So do you have to keep receipts? If you do keep receipts, how long do you have to keep receipts?
Fantastic question. So the IRS says IRS can go back 3 years and audit you, and you have to be able to prove whatever deductions or whatever strategy you took.
Okay.
Now, if they find an error greater than 25% of the tax liability, then they can legally go back 3 more years. So that's why they typically say, hey, save receipts from the past 7 years.
Yeah.
Because tax year is a year behind anyway.
Right.
So it's going to be 7 years back from where you are is where you want to save your documents to.
So there's a method behind that 7 years.
Oh yeah, for sure.
Okay.
Yeah, that's why they say that. Now, it's rare that you have to get that second 3 years open, but they only do that if they feel that there's enough meat on the bone to find something else.
Got it. Right. So if they find something, they're going to keep finding, right?
Exactly.
They're assuming like where there's smoke, there's going to be a fire. Right.
That's exactly it.
Okay. So number one thing is we have to be accounting, right?
100%.
Be accountable. I think that you should be accountable anyways. You should know your numbers because you should know your numbers.
I agree.
And B, you shouldn't be lying anyways, right?
Boom.
So
yeah, and
God's watching you either way.
That's true. He knows your heart.
That's right.
What was I going to say? Oh, yeah. So your numbers, so imagine your vehicle your household is like a vehicle.
Okay.
And like a car. And let's just say your numbers are your fuel gauge. And as a matter of fact, it's your dashboard. Like your numbers will let you know if your check engine light is on. Hey, you need to, something is wrong.
Sure.
Look into this before the problem gets worse. It'll let you know, hey, your fuel is running low. And that's the juice to get you from where you are now to wherever your goals are. Now, if you don't have enough gas in the tank, if you don't have a clear set of numbers, you won't even know if you have enough gas in the tank. You'll just be managing life by your bank balance. And we all know that's not sufficient, especially when anything can pop up. You don't know if you're profitable month over month. You don't know if you're losing money.
Yeah.
It can really come back to bite you.
Yeah, living life by the bank balance, man. I remember those days, going to, I don't know, Taco Bell.
Yep.
Checking the bank account. All right, I got $7.
Exactly.
That means I can pay $6.99.
Exactly. Crunchwrap Supreme, I don't know.
That was probably Crunchwrap Supreme in there.
Yeah, I remember those days.
Okay, so number one is becoming, you recommend people use an outside bookkeeper, or, I mean, not every business, I guess, is that complicated. Some of them, like if you're owning a restaurant, probably need a bookkeeper. Right. There's a lot of moving parts there, but if it's, a basic service business, maybe they could just kind of do it themselves.
Yeah, I agree with that. So basic service business, you can do it yourself for the most part.
Sure. Is there a threshold or a number of transactions? Like, how would you determine somebody could do it themselves versus they need
that's a great point.
Accountant or a bookkeeper?
So generally, revenue is a good indicator of what stage you're in. I'd say once you're getting to about I'd say 150 in gross revenue, you may want to consider a professional.
Okay.
And the reason why I say that is because there are just things that you will not know. For example, you may be counting transfers as income. You may be making bank transfers and accidentally counting that as income.
Yeah.
You may be invoicing, and there are issues where the software will double count income as well. And you're just not going to know unless you're doing something called reconciling your books. And most people aren't going to do that. But a professional is, and that process involves looking at your bank statements, then looking at your accounting software, and then making sure everything that's on the bank statement shows up in the software. And if something's in the software twice or 3 times, which the software is notorious for duplicating entries just randomly because it's technology. You're just not going to know. So most people that overpay on their taxes, believe it or not, their accounting is usually wrong first. And so if they had someone just looking over their books that knew what they were doing, they would really end most of those problems before it was even tax time. Most people are overpaying in taxes because their accounting is wrong.
Interesting.
Matter of fact, I saw a client who had a delivery service, package delivery company. She had over $500,000 in other income that shouldn't have been on there. Yeah, basically there was this credit called the Employee Retention Credit. And people got it back from the IRS. Well, actually, in this case, she actually had a bookkeeper, but it's also, you want to make sure you get a
good bookkeeper.
Exactly. And the bookkeeper was considering that as other income, and that's not how it works.
No,
so she was actually couldn't stomach her tax bill, and she was like, "Can you help me?" And I was like, "Oh, your accounting is wrong."
Yeah, but you caught that.
Yeah.
So I mean, let's look at, and then boom, other income. Well, what's this income? Well, that ain't income. Right?
Exactly.
Okay. All right. So get a bookkeeper. Make sure your books are right. Documentation is key, right? To first know where you're at.
Right.
Okay. So now we've got that squared away. We know the situation. We got too much money coming in, not enough deductions.
Right.
And don't necessarily want to buy another truck.
Right.
Or, give away all of it to charity or whatever, right? So then there's got to be something else. Right?
Yeah, you're exactly right.
Okay.
So great question, because actually that's what most people think. They say, hey, my accountant told me to go out here and buy a truck, and now I get to write it off, or hey, I went out and bought a boat, or I bought a plane or whatever. And right? But the thing is, a general rule of thumb, is that a third of whatever you're spending is what's going to reduce your taxes by. So for example, if you spend $3,000 on something, it's going to reduce your taxes by $1,000. Does that make sense?
Of course, because if your tax rate is, call it 33%,
exactly,
then it's going to reduce it by that much. That round numbers make sense. I got that.
Right?
All right, I'm tracking.
And so the problem with that is, okay, well, if you didn't need an extra $3,000 thing, you're only buying it to save on taxes.
Well, you're wasting $2,000.
Yeah.
Yeah, got it.
That's exactly it.
Got it.
Okay, so that's the biggest challenge. Okay, now.
Or if I bought the truck, say last year, that was last year's strategy.
Mm-hmm.
Well, do I really need another truck this year?
Exactly.
Right. So now that, again, there's going to be there's another way.
Absolutely.
Okay.
You know, there's you're exactly right, Ryan. There's something called permanent tax saving strategies, and a lot of these other ones are more so temporary tax saving strategies. So
yeah, we don't want the temporary. We want the permanent.
We want the permanent. Exactly.
We want to get Uncle Sam out of the pocket for good.
Exactly. It's kind of like a strategy you put in place one time, but that will pay you not just this year, but every year you're in business.
That sounds like. So wait, there's residual income,
right?
And there's residual tax savings.
Let's go.
I'm in it, bro. That's good.
You're exactly right, man. So an example of that, is like this. So you have 5 children?
4 children. Yeah,
4 children.
Four
Okay.
Children. Yeah.
Oh, one on the way.
No.
Okay, no, I'm just just kidding.
Not yet.
Okay, so 4 children, and you can legally, everybody's under 17 right now.
Yes.
Okay, so you can legally, I'm sure you heard of writing off your children.
Yeah.
Okay, and so that
meaning pay them.
Literally, yes.
Oh, listen, we work the kids.
Okay, solid.
They come to the office, like, not for nothing, but it's my son that's running our video equipment right now.
Right now.
Right?
Yeah.
Now, that's work.
Absolutely.
Right? This is a legitimate business thing that we're doing right now. We're doing a podcast. We're promoting business and all of those things. My daughters also do the same thing. They'll come in. They'll do things with either video equipment. They'll staple stuff, fold stuff, right? Mm-hmm. And I think this is a key piece, right? Because we talk about writing off the kids.
Absolutely.
But the kids need to do something.
Absolutely.
Okay, all right.
Absolutely. How old is your youngest?
So my youngest is 6. I do the older 3.
Okay.
I figured the 11, 13, and 14-year-olds, almost 15-year-old, those all, it makes sense. They can actually do something for me.
Exactly.
The 6-year-old, we try to keep her from bothering the other 3 while they're doing something.
Sure, makes sense. So even if you only hired 3 children, that's doable.
Yeah.
But where most people are able to legally write off or pay the 6-year-old is by having them in promotional videos. You pay them an appearance fee. You know, you ever watch these shows? What were the twins' names from Full House?
Oh yeah, Mary-Kate and Ashley.
Yeah, Mary-Kate and Ashley.
Yeah.
Like, they got paid.
Yeah, they did.
And you know what I mean? And like, what were they doing? They're just talking.
They're like billionaires now.
Yeah. Oh yeah. Of course.
They got paid.
They got paid for sure. And so is there legal ways to pay a child? Yes.
Got it.
Now,
that makes sense.
You want to have them in promotional videos. That's easy.
You just have to have a way to legitimize what it is you're doing.
That's
right?
exactly
like,
it.
hey, we have this tax strategy. I want to do something to be able to take the benefit of that tax strategy, but I don't want to lie. So let me do something to substantiate.
That's exactly it.
So, cool. So paying the kids.
Paying the kids.
All right.
So that's one. And because they're under 17 or under 18, they're going to be exempt from Social Security and Medicare taxes. So when you're doing this, you want to set them up on your payroll, the same payroll company that you're paying yourself on for an S Corp or that you're paying your employees on.
Yeah.
You add them on as well, so they're going to get a W-2. Now, but there's a box on there you check that says exempt from FICA withholdings. And so they pay no taxes of any sort. They don't have any federal taxes withheld because you don't pay them more than the standard deduction.
Sure.
And so we'll just, for simple math's sake, we'll call it 13. I believe it's 13.9 right now.
Yeah.
So almost 14,000 that you can pay them, and literally they'll pay no tax on. That's federal, Social Security, or Medicare. So why do you do that? It's because you already do things for your children anyway. You already, pay for taekwondo. You're paying for track meets, soccer, pageants, whatever. The money you're paying them, you use that to buy groceries. You use that to buy the things that you were buying for them anyway, because we all know children are expensive.
Yes.
That's how it works. So that's how that strategy works. And if you have 4 children, we're looking at almost 14K times that. You're looking at about, let's see, 28.
It's almost 60K, right? It's like 50.
So that's 28 and it's 54.
Yeah.
54K.
Yeah.
And general rule of thumb, 1/3 of that. So that is, let's see, my math is off, approximately 20 something K as a write-off.
Yeah, man.
As a savings, 18,
as a tax
17.5, 18
as
a
a
tax
savings.
savings. Literally. Off of your tax bill.
Because this is income that I would have had that's coming into our household anyways.
Exactly.
Now I just say, hey, look, we're going to bring it through the kids.
Exactly.
Right? And they're going to help with the household expenses now.
Exactly.
But we can use that to now whatever we paid them, call it $60,000 for round numbers.
Right.
20 of that is now the tax savings.
Literally.
So not only does that 60 come in, but it's now a real 60 instead of 40.
Exactly.
Got it.
And so how it works is the actual term for that is called income shifting.
Okay, income shifting.
Yeah.
See, income shifting. Doesn't that sound cool? I'm a shifter.
Shifter. And so that's the beauty in it, man.
Yeah.
And that's why they say, hey, how are your kids? That's a simple, easily marketable term.
Yeah.
It's called income shifting because each person has different, tax rates. And if you're already making well over the standard, how can I? Because we have a tiered tax system.
Yeah.
So everyone
right.
gets pay zero taxes on your first, up to 14K.
Right.
And then the next gets to the next tier. And then so we all are tiered. So when people say, hey, I'm in a higher tax bracket, that just means, like you have money that is climbing in the upper tier, but you got the same breaks as the next man. You just kept going.
Yeah, right. Crimea River, right?
Exactly.
Listen, we're discussing good problems.
There you go. We're just good problems to have.
Because that's a thing that we gotta keep in perspective.
Exactly.
Is that we have to have the good problems, because if we're not having the good problems, then we got real problems.
Exactly.
Yeah, man.
Exactly.
So so we got number one was we got to have an account.
Absolutely.
Right? Or do the accounting, substantiate the accounting, back it up, document it. Number two, now that we've got documentation, now we can do some income shifting. And the example that you gave was the kids.
Exactly.
Okay, all right.
And the documentation you get from that is actual W-2s.
Right.
So it's super clean.
Because you say you do it through the payroll company.
Exactly.
And just check the box where they don't pay the FICA.
Exactly. They'll get W-2s, and you could. It's just super simple.
Yeah. That's clean. That's
exactly.
Fair. Yeah. Well, and not for nothing, but maybe this is a plug for payroll services, right?
Sure.
You should be using a payroll company. I think the IRS gives out something like 8 million penalties a year, something crazy, to businesses that were trying to do their payroll taxes on their own, and they ended up paying either the government agency too late, whichever one it is, and depending on what state you're in, you got 3-5 entities you got to go pay to with different due dates, and different amounts and different calculations and all that. It's just too much of a headache. Look, there are business owners out there that still do it the old-fashioned way, and God bless you guys. But I guarantee you, if you took the time that you would use on doing payroll and just plugged it into a payroll calculator on a payroll company's website and let them do all the heavy lifting for you, you would do better. So just trust me on that, because you could take that same time and make more money. And that way you're multiplying income by orders of magnitude instead of trying to save by pennies on the dollar for percentages.
I agree. And I actually like Gusto, because you can you can set it and forget it. You can literally set it up one time, make it auto draft from your account, and you don't have to worry about running payroll.
Right. So there's several ones, man, that have popped up, especially for the smaller merchants where they've only got a few employees and you just need something. Gusto's a good one. Anyway, there's plenty out there, but seriously, use a payroll company.
I agree. Can I tell you one more reason why you want to do that?
Yeah.
So
please.
when you're filing payroll, you're a fiduciary for the IRS. And that means, hey, I'm holding the IRS's money.
That's right.
Until a certain date. And if you don't file your payroll taxes timely, that's one where they can really shut down your bank account and garnish your money out, because it's seen as stealing from the IRS if you don't file that timely.
Yeah, man.
Yeah.
That's facts.
Absolutely.
Yeah. That's the same thing with sales tax.
Exactly.
Not for nothing, when I got into business, I didn't think I was signing up to be a bill collector for the government.
Right.
But all of a sudden they come and they're like, hey man, this little organized racketeering gig we got going on.
Exactly.
Where's our money?
Right. Where's our money now?
That's right.
Yeah.
That's right.
Yeah. And
the more you collect, the faster they want you to pay it.
Oh, 100%.
Yeah. So even that's confusing.
Yeah.
So that's a whole other.
It's a can of worms.
There's taxes on taxes.
Literally.
Literally.
Yeah.
Funny.
Of course, our mentor says it, and I agree fully. Myron Golden says, what's your second largest expense that you're going to incur in your life?
Yeah.
And the second largest is taxes.
Yeah.
And he says the first one is, not knowing how to do the thing that you'll need to do in order to earn
That's right.
your maximum potential.
That's right. No, that's right. Actually, he does an example where he takes that $1 million, right?
Yep.
And he says, okay, well, how much do you make in a year? And somebody says, oh, I make, $75,000, right? And they're like, okay, so we take $1 million and we subtract, 75,000. So that's $925,000 that you paid life last year and every year before that because you didn't know how to make $1 million.
Exactly.
It's the biggest expense. And that
the biggest.
Make your brain hurt, make you mad,
Boom.
The whole bit. And then the fact that the second thing is taxes is another thing people don't think about. Most people, in my estimation, are getting a W-2 wage.
Right, I agree.
And so they have this crazy little system that they set up at the government, right, at the IRS, where you get a refund of your own money, and you are happy about it.
Yeah, you know that. You want to know why that is? I learned this in college.
Okay.
That's called the administrative convenience principle.
Okay.
The administrative convenience principle. It means we're going to get our money from your W-2 while it's convenient, because they let people at first, hey, just send us this in. And you want to know something weird that happened? They weren't saving the IRS's cut.
Yeah, no, for sure. Yeah.
So IRS was like, we can fix that.
Yeah.
Let's start taking our money. So
right out of your paycheck.
Employers,
right.
we require you now to withhold. And that's why they do that. I mean, they do that on everything. 401k withdrawals didn't used to require, if you get a withdrawal from your 401k, it didn't used to require the IRS to hold that back. That used to be optional.
Right.
Now it's mandated because
it's like when you win the lotto, they do withholding.
Exactly.
Yeah.
Because they say, hey, we'd rather get too much now and refund it back than you not send us our portion.
All right. So
yeah, we're going left.
No, it's all good. We're making some progress. I'm just, this is good. This is good information for you guys. It's good that you get all of these things. Truly, the first thing you want to do is go find a way to make some money.
Literally.
Okay. Because this is the problems that you run into once you start having the money. If you're, not making money yet, I got another video for you that you need to watch. Those of you that are making money, you need to get with my man Charles here. That way you can figure out what it is you need to do now that you are making some money. So, all right. So we've got some income shifting. We're accountable. We got it documented. What's some other strategies that we can use?
Absolutely. So here's a strategy you may have heard a lot about, but people may not know how to utilize. And this strategy is golden. It's called the Augusta rule. Have you heard of that?
Okay. Is this because of the Augusta golf tournament?
Yeah.
Okay. I've heard of it, but I'm gonna let you explain it because I probably would butcher it.
Yeah. So the golf tournament in Augusta, Georgia, the Masters, is held there. So this was born out of the golden rule, and you know about the golden rule, which is he who has the gold makes the rules, right? And so what ended up happening is people were making an inordinate amount of money in a short period of time for leasing their home out during the Masters. So guess what? They say, well, hey, you know what? We don't want to pay tax on this.
Yeah.
So let's get a rule made.
Let's go.
Right?
There's some big deals made on the golf course.
Literally.
Right?
Literally.
That's right.
Play golf, people.
Yeah.
Yeah, play golf. And so they literally got a rule passed that says, hey, if you rent your home out for less than 14 days in a year, then you can exclude it from your income. So
it's income, but it doesn't count.
Correct. So how you do it is this, because a lot of people think
makes the goal makes the rules.
Literally, you see that?
That's true.
Because it's like, what? Like, we're just going to throw that in specifically for Augusta?
Yeah.
Like, okay.
Yeah, okay.
And so what ends up happening is it ends up becoming a free expense. That's the best way to use it, because if you're not renting your home out to make money and just exempt the income,
right,
this is what you do.
Okay.
So then, Ryan, you take your business, you say, hey, I'm going to charge. And then whatever, you have to have an entity. It needs to be like a corporation or LLC.
So me, I could take Champion Payments, are my business.
Champion Payments, yes.
And I could do this with my entity.
Exactly.
So what would I do?
So you say, hey, I'm going to do short-term rentals for Champion Payments. You can rent, your house. So you take your home address, 123 Anywhere Drive. You say, and Champion Payments, you say, hey, I'm going to bill you whatever the market rate in your area is.
Okay.
Now, it's actually going to benefit you to look at comps in your area, but you want to look at it whenever things are the highest, seasonality.
Yeah.
Whether rents get higher in the summer, or if you have a special event come in town,
sure,
look at the rates during those days. And guess what? You want to rent your home to your business on those days.
So me as a person, Ryan, I will be renting my house to Champion Payments, my business.
Right, exactly.
Okay.
So just say, for simple math's sake, it is a 4,000 square foot home.
Okay.
And then you look at comps in the area. If you were to rent an event space in that area, or if you look on Airbnb and you see per night, maybe it says
if it's event space, bro, we're talking $500 an hour.
Boom. That's exactly it. Do you see what I'm saying?
I do.
And so let's take the $500 an hour.
It's like those cartoons where the money signs start.
You
like,
see that? Exactly. So at the $500 an hour for 8 hours, we'll call that $4,000 a day.
Okay.
And let's just say you take that $4,000 a day, 14 days is the max, right? So what's 4,000?
So can I take it by 8 hours, or does the 8 hours count as a whole day?
You can take 8 hours, or if it takes you 10 hours.
And that's part of 24? And I could do 14 times 24 hours and do it by the hour?
Well, if you'd have to be able to substantiate it.
I'm just saying we got to get it all the way.
Yeah, absolutely. It's possible because do you remember?
You just have to be able to explain it. So
literally,
right? Okay, because I've had like one conversation where I had to explain something. It wasn't an audit, but one conversation we had to explain something, and it was literally like, "What is this?"
Right.
And we explained it, and they were like, "Okay."
Yeah, the more proof, the better. So, for example, you remember that song "Happy" by Pharrell?
Yeah.
And
I'm happy.
Happy, exactly.
Yeah, okay.
He had a site that played that 24 hours. So just say you're doing a marathon of some sort for 24 hours during those 14 days.
Sure.
And it was online. Guess what? Now you've got evidence. And now the 500 can be used for all 24 hours.
Got it.
Does that make sense?
Yeah, I see.
You can use it for content days. You can use it for customer appreciation. You can use it for team member appreciation. You can use it. And if your family works with you.
So like if I do 1 hour for one of those days, it has to be that calendar day. I can't then take 1 hour from this day and 1 hour from that day and put those together as 2 different hours.
Right.
Those each count as a day.
Because you only get 14 days.
14 calendar days.
Right.
I don't get the number of hours. I couldn't like extrapolate the hours on different days throughout the year.
No.
Okay, that's what I was saying.
Yeah,
okay.
good question.
All right, don't do that. That was
No.
me just trying to skirt the system.
That's close though. But you know what?
But
you
now
could
you see
do,
why the IRS stops people, and checks this stuff out.
Exactly. Yeah, you just want to be able to have something to substantiate your evidence. So,
Right.
for example, just say you and your wife, you have board meetings. You talk about visions of the company.
100%.
Right? And just make an agenda. You know how like you go on a retreat and then you talk about big vision items and you have open Q&A and then, hey, we're going to have lunch from this time to this time and then we're going to reconvene at this. Literally have an agenda.
Yeah.
And long story short, you want to have a 1-day rental agreement for each day, but to fast forward, and I don't want to get too detailed.
Yeah.
4,000 times 10 days, that's 40K, plus the other 4 days, 4 times 4, that's 16. That is $54,000.
Yeah, 50. Yeah, 50, okay, 56, 54.
56, 54.
Yeah.
I'm doing this math roughly, and it's a little bit late.
It is late. It is late.
So either rate, you're looking at another approximately 17 to 18K off your tax bill. So far with the 4 children, 17, 18.
Yeah.
With this, that's about 18. So far we've knocked off about 36K off your actual tax bill.
That's
if
great.
you implement it. Does that make sense?
Yes.
Okay. You want me to tell you another strategy?
I do. So granted, this works, especially if you paid more than $36,000 in taxes.
Correct.
Right. So you can stop at some point if you're not paying that much in taxes, right?
Yeah, you can stop, but even if you, even if your expenses start outweighing your income, that's going to put you in something called a loss.
Yeah. So can you carry that over? Or?
It can offset any W-2 income that you have. So if you have a loss, and you've already paid in taxes, so it can not only bring your liability to zero, but just say they've been holding money out of your W-2, you can start to get a refund back now.
Got it. Okay, so that's interesting. And then how long can you operate at a loss though? Because I've heard that you can't do that forever.
Yeah, so at the end of the day, to be honest, there's people say a lot of rules.
Yeah, it's like green belting in Florida, right? You get agricultural tax break on your property tax if you're agricultural land, and you can substantiate it, right?
Right.
Well, what does it mean to be agricultural?
Right.
So there's some leeway there. How many cows is agriculture, right?
Exactly.
How much crops is ag, you know what I'm saying?
Right,
so
exactly.
Same idea. So
same idea. Now, really, I think Amazon went almost 20 years before they turned a profit. Now, your ability to take this is based off of what you can substantiate. Exactly.
Yeah.
Does that make sense?
It does.
And so, yeah, a lot of people say, hey, you want to avoid hobby loss rules, don't have more than 3 losses within a 5-year period of just getting started.
Yeah.
But if a person didn't have an LLC of any sort, don't have any business bank account, didn't take steps towards business legitimacy,
Sure.
the IRS is like, that's a hobby.
Right,
But
right.
You know what I'm saying? But
yeah.
if you have a website, you invest in advertising, you have all the things. So the IRS says you have to be in pursuit of a profit. If you're in pursuit of profit and you're just losing money.
Amazon was clearly in pursuit of a profit.
Of course, right? Then, I mean, the IRS is like, hey, that's a valid business. So it doesn't matter even if you have more than 3 years worth of losses or even 5 years, if you're legitimately running a business.
Sure. No, that makes sense. Okay. All right. So you said there was another strategy.
Sure, absolutely.
I want to hear the last strategy, and then I want to hear, like, how in the world did you get all this? You know? So that's
absolutely, absolutely. And funny enough, all these strategies are based off of what you would like to do. Anything, like, there are over 1,500 different strategies out here that I can literally help evaluate a person, like, lifestyle, and say, hey, based off of this, 72 strategies apply to help offset your taxable income.
Yeah.
And so in this case,
so it's specific, because think about it, right? We always hear the tax code is like, this thick.
Yeah.
So what you're saying is, you've been through it, you've got all these different things that doesn't apply to everybody.
Exactly.
So we got to find the ones that apply to you.
Exactly. And the tax code is 95% of it is actually talking about deductions and ways to save the taxpayer. And 5% is talking about collections.
Yeah, how funny.
Did you know that?
Well, I know that, like you said, he who makes the gold makes the rules.
Literally.
And they ain't trying to figure out a new way to pay taxes. They're trying to find a new way to not pay taxes.
Exactly. So one other way is I like called like lifestyle conversion. And basically there's a way where, you know how like there are some expenses that you can write off in your business?
Sure.
And then some expenses we just have as being a human, like eating, or just say we want to go on vacation, we want to travel.
Yeah.
Or just say we want to, buy something for our family, like a TV or whatever. Right. Well, there's a way, or a computer. There's a way to legally take things you normally don't get a deduction for and have a way to legally write that off in your business as a business expense.
Okay.
Right?
All right. And, so things we would already do.
Right.
And so just like we did income shifting, it sounds like we're doing expense shifting.
Ah, that is good.
That's right. Yeah. Follow me for more tips.
That's solid.
Yeah.
So how you do that, Ryan, is something called an accountable plan.
Okay.
An accountable plan is like a fancy way for saying an expense reimbursement policy. It's saying, hey, we're going to give every executive in the company a car allowance, $1,500 a month for the
nice car.
Yeah, it's a nice car, really nice car, right?
Executive, you said executive.
Executive, right? And that way,
car.
Everybody that comes in the company doesn't have to get it, because it can't be discriminatory, but you can set levels. But what that does mean is if anyone makes it into leadership, they have to get the same perks as you.
Got it. Yeah, it makes sense.
Makes sense?
Yeah.
And so, hey, everybody's going to get an allowance to buy a computer. Or you can say, hey, we'll do expense reimbursement for any personal items that he's bought that he's using for the business, which includes cell phone, which includes, cars, various things like that.
Sure.
There are legal ways to convert personal vacations into business-related vacations.
Well, I can tell you right now, we're at the JW Marriott in Tampa, Florida.
That's
and
it.
You just saw I got my whole family.
Right?
Literally. So while they're at the pool having fun, I'm over here, learning and
literally working.
Because to say learn more to earn more.
Come on.
Right? So, but I'm also expense shifting. Right? I'm expense shifting.
Yeah, that's it.
Right as we speak,
Literally, you really are.
Listen, I'm your best student already.
Let's go. So, this is exactly those are just a few principles that the average business owner can use to save a ton on taxes.
Yeah.
But it's all about permanent tax saving strategies involve just literally tweaking the way you do things. Like, yeah, you still do it, but just it's a little bit more.
Right. So this is something that becomes a habit.
Exactly.
This is something that, especially like you said, lifestyle shifting, income shifting, paying the kids, right? All of these things seem like things that you would change the way that you did it so that this is how we do it from here forward.
Exactly.
Because otherwise, it sounds like a lot of work. It's not a lot of work to take my family with me.
No.
To now write off all that stuff, right? Like I could have been sitting by myself in a hotel room.
Yeah.
And I'd still be writing off that one hotel room,
That's exactly it.
But now because we're having a board meeting, right?
Literally.
I get more expenses out of it. We get to enjoy as a family, and I do get to enjoy. Don't get me wrong, right? It's not like it's all work and no play.
Absolutely.
All right, so okay. Then there's one more strategy I didn't hear you talk about that I am interested in.
Sure.
That I want to hear you specifically talk about, because there's a lot of gurus online that talk about the real estate depreciation savings.
Absolutely.
Okay, and I think this is one that can get people in trouble if they don't do it right.
Right.
Now, I only know about the issue. I don't understand the ins and outs of the issue. So I'm going to let you explain it.
Okay.
But tell me about this depreciation. Man, I see guys, like I said, online talking about, oh, don't worry, you can pay no taxes ever again.
Yeah.
Because you're going to be doing X, Y, and Z.
Yeah.
But it's like, I have a gig that I already do. Investing in real estate would be a hobby, an investment for sure. And I'm sure there are some write-offs.
Sure.
But like the whole no pay taxes ever, pay taxes no more, right?
No more.
Is it that simple?
I want to say yes and no.
Okay.
I want to say
like
yes
a
and
true
no.
accountant.
Exactly. And here's why I say that.
Okay.
So this is a fun conversation. I really love these.
Okay.
So when you look at it, they have a lot to do with rental properties, right? So if you have a rental property, there are several things that happen, but when oftentimes most rental properties are going to have something called a paper loss. It means in real life you may have a positive cash flow of about $400 or $500.
Sure.
But on paper you end up losing what's called $7,000 or $8,000. And the IRS has something called passive loss limitations, which means the IRS only lets it bring your tax liability down to zero or bring the income down to zero, and the rest of those losses get carried forward. They don't reduce your other taxable income. Does that make sense so far?
So it only offsets the income I would get. Those losses only offset the income I would get from that rental property.
Correct. And anything
it wouldn't
beyond
offset
it,
like my other income from the business or my W-2.
Correct.
Okay.
Because that's basic passive loss limitations.
Okay. I didn't know that existed. I just learned something.
Yeah, but so what people are talking about is, hey, become that whole real estate professional. That allows you to claim your losses beyond. So for example, if your rental income was at $10,000 and your rental expenses were at $20,000, well, this will allow you to take that $10,000 loss and let it offset your W-2 income or your other business income.
Okay.
Right? So either real estate professional, or if you had your income was less than 150K, there's something called active participation. And active participation is similar to real estate professional. It just means you can write off all those other things if you are the one who's orchestrating cleaners, maintenance, if you're orchestrating other stuff to be done to your rental properties.
Active participation.
Literally.
Okay.
Does that make sense?
Yeah, it does. It totally makes sense. So there's two options to be able to take that offset type of deduction.
Right.
And that is, I need to be a real estate professional.
Right.
Which we can define that in a second.
Right.
Or I, as a person making less than $150,000, which hopefully that's none of you, but maybe it is.
And
right?
if it is, it's okay because
no,
time
if it is, take
gonna,
the tax savings, right?
Yeah.
Especially if you're getting ahead by doing real estate. Because if you're making less than $150,000 and you're still investing in real estate, man, kudos to you for doing what you should be doing to manage your finances.
Absolutely.
I think that's amazing.
Right.
All right. So then, but what about this other side over here, this real estate professional?
So this real estate professional, if you're over 150K, nothing else is going to work unless you get that designation. And there are a few ways to get it. But so either one, to be a real estate professional. A lot of people's common misnomer that, hey, if I go out and get a real estate license, then boom, I can instantly qualify for real estate professional. But the real estate professional designation has nothing to do with the certification, but everything to do with meeting the IRS's rules on it, which means, hey, you have to have at least 750 hours in real estate, real estate related activities. And you also need to make that be the primary activity that you do. So if you have a W-2 job and you work 40 hours a week there.
But I'm doing my extra 15 as a side hustle.
Right. Then
that
won't
doesn't
count.
qualify.
Exactly.
Okay. All right. So,
right.
Okay. So then if it's a side hustle at all and not the primary thing, then can you qualify for it?
It could. So if the real estate professional is a side hustle, you mean?
Yes.
There's yes and no, and here's how.
I can see.
Right.
Yeah.
Here's how, because let me just go back and say this.
And that's not meaning to say, like, let's say that I do literally do payment processing, right?
Absolutely.
We have all these accounts, but I've built up a big book of business and I literally work part-time.
Then that's okay.
As a payment processor. And now I'm saying, well, my main gig is real estate.
So in this case, so the 750 is a minimum, right? 750 boils down to about 15 hours a week. So if payment processing only took 20 hours and real estate took 21 hours, now you have a win. So you have to exceed the 15 hours, but we're just trying to make sure that it exceeds.
Got it. So these guys that are saying to do this strategy, the one thing that they aren't saying is real estate needs to become your full-time gig.
Correct. That's what most of them aren't. They're not really telling you all the details.
Or they're counting on the fact that whoever's watching it, which there's a probably 90% chance that they are making less than 150K a year.
Right.
Okay. All right. So then I'll give a pass there.
Yeah. Believe it or not, if your adjusted gross income is over 150K, you're actually considered in the top 10% of income earners in the nation.
So I was right, 90%.
Yeah, literally.
Yes.
Yeah. You're on it, man.
That's a rock star numbers out there,
Ryan.
Yeah.
And so there's another way to win too.
Okay.
So let's just say you do have a full-time job, right?
Right.
Or just say not necessarily job, but you're running your business full-time.
You have a gig that is bigger than real estate.
Exactly.
Okay.
Well, you're also legally allowed to use your spouse if you're married. And if your spouse doesn't work outside the home, just say they're stay-at-home husband or wife.
Sure.
Well, guess what? Now they only have to do the 15 hours. And because they're eligible and you're married, their eligibility applies to you. So now you can write that off.
Got it. Right? Teamwork makes the dream work.
You know it. Let's go, right?
That's right.
And how it works, there's two strategies combined that can literally ensure you never pay taxes another day in your life. And this is what the experts, like some controversial people, but like Donald Trump. This is how when he releases
a billionaire
tax
paying $750 in taxes.
You see what I'm saying?
Right.
You also have Robert Kiyosaki.
Yep.
Who, and all these, you also have Grant Cardone.
Right.
These people are using real estate because it's one of the most powerful, it's solid investment tool, but not just because of the return on your investment and the way property appreciates, but also because you get so much of a write-off, it is like almost free money back to you.
Sure.
Right? It's the gift that keeps giving.
You're already buying cash flowing assets that are paying you, but you're also saving on taxes because that's the vehicle you're using. So it's almost just like income shifting.
Literally.
Right? You're just putting it into a different avenue. Now, the one thing I have heard about this, and maybe you could correct me.
Sure.
The one caveat is that you get that depreciation, right? That upfront depreciation, and it compounds after that, right? However, because you buy more properties, but that you have to keep buying properties.
Correct. So that strategy is called cost segregation.
Okay.
And cost segregation is, all right, so the IRS has a table that allows you to depreciate only a portion of big assets.
Okay.
And they do that because they don't want you just buying stuff and never even having to pay taxes.
Right.
So everything has what's called a useful life. So for example, computer would have a useful life of 3 years. Car had a useful life of 5, which meant if you bought a car, this is before Section 179 bonus depreciation came out due to the Tax Cuts and Jobs Act that Trump released in 2017.
Yeah.
But prior to that, really, it would take 5 years to write off a car that was under 6,000 pounds. And so I'm saying all this to say, for rental property, usually you have to write off a portion of the home over 27 years. So
it.
you get 1/27th of that write-off per year. Well, what cost segregation does, it allows you to write off substantial portion of that house much faster, sometimes in as little as 1 to 3 years.
Okay.
Right?
Yeah.
But what it really does is it takes the useful life of all the individual components instead of looking at a house as a whole. So if a house as a whole is 27 and a half.
I gotcha.
Yeah, the useful life of wood can be expensed all in 1 year. Of nails can be expensed in 1 year. The sheetrock. The PVC
everything.
pipe.
Yeah.
The carpet. You know what I'm saying?
Got it.
The fridge, exactly.
There's always a loophole.
Literally. So it's like, hey, we're not looking at the whole structure. We're looking at the individual components.
Hence cost segregation. Got it.
You see what I'm saying?
I do.
Man, you're getting this.
Yeah, well, listen, man, I'm just trying to look. I'm a working man. You know, I got to work it out into third grade. However, so that I can swallow it, you know what I mean, and digest it and all that.
Hopefully, this is not too complex, too.
No, I don't think so. I
Okay.
think no. I think that we're on point. At least,
Okay.
Look, if I can understand it, I'm hoping that you can understand it. You know what I mean? That's what I'm thinking.
Absolutely.
Okay, so we've kind of figured out who can take these deductions.
Mm-hmm.
The cost segregation piece is like a secret way to take the deductions faster.
Exactly.
And then you just have to keep buying properties, because what happens is then otherwise it catches up to you.
That's a fantastic question. So, yep, you're right. Normally, when you have your rental property, we talked about a paper loss. So let's just say, let's use that same $10,000. Let's say
because you messed it up 1 year and you got a big paper win.
Exactly.
Yeah, I got you. Okay.
Do you see what I'm saying?
Yep.
And the reason why is because just say $10,000 income after expenses. Let's just say it's $5,000 in expenses. Then let's just say you have depreciation of $5,000.
Okay.
Well, when you use the cost segregation, $10,000 income, that $5,000 expenses, now depreciation, let's call it $100,000.
Oh,
well, yes.
That now, because of the designation, offsets everything else.
Exactly.
Yeah.
So any other W-2 income, any other profit from any other businesses, literally it's where people get a fat refund back. Yeah, this is pretty lovely, right? Huge.
Yeah.
And I've seen some big refunds.
Yeah.
Now, the reason why you're like, okay, you got to keep buying more properties is because you just used almost all of your depreciation in 1 year.
Got it.
So what was normally offsetting, every year for the next 27 years, now there's nothing else to offset that. So the reason why you buy another home is because one is going to increase your overall
holdings. Yeah,
your holdings.
It's an
exactly.
investment. So it's to win there.
Exactly.
You should be buying stuff anyways to invest.
Exactly.
Because the ideal here is either the cash flow from your properties in the real estate professional, or if you're making residual income from payment processing or whatever, then you're taking this and now you are able to take this income and you're able to cover it in a cloak of depreciation.
Literally.
Right? Like you don't see this. And what we don't want is to have a year where, because every year it starts to slip off, right? You got to pull it back up.
Exactly.
Buy another property, but we're layering it continuously.
That's exactly it.
Yeah.
The beauty in it, honestly, is I've built a little course on this.
Yeah.
But the beauty in that is that when you're so if you normally are about to owe the IRS, let's call it $100K, and you're like, man, I'd really like to not give the IRS $100K.
I would really like to not pay the IRS $100K.
Exactly. What can I legally do to keep $100K?
Yeah.
Then guess what? You had a rental property. You implement the cost segregation, granted that you meet all the other requirements.
Right.
Now, just say you go out and buy a property that's worth $300K.
Okay.
Right?
Yeah.
Now, guess what? We do the cost seg on it. Now, literally, not only do we eliminate that $100,000 tax bill, but let's just say you put $30,000 on 3 homes, 3 single-family homes, because you only need a down payment.
Right.
And then now we have 3 properties that we can use cost segregation on, and just say you use 1 a year to eliminate your tax bill. Now you're golden. And then guess what? Instead of giving them $100K, you've literally taken, because the IRS gives you strategies, by the way, the IRS code is written to be incentives to encourage taxpayers to do certain things.
Right.
Right?
Okay, that's a good point, right? Because I think a lot of times we all think that, the government's doing this to scratch the backs of their cronies.
Right.
Which that's 100% true. However, they're trying to scratch the backs of their cronies to get them to do things. They're like,
literally,
I'll scratch your back if you'll do this for me.
Exactly.
And so what they're doing is they're trying to stimulate certain economic drivers.
Literally.
Yeah. I got it.
So like if they want, hey, we want to see more housing development in the market, we're going to give real estate investors credits.
Which is why they came up with like opportunity zones as well.
Literally.
Right. So there's places they're saying like, not only do we want this, we need to find a way to do it like in this area or in that area. We want to encourage development or redevelopment in certain markets, and they created those opportunity zones and stuff like that. That makes sense.
Those are lower income areas as well, usually.
Well, right. I get that. Which does what they want it to do.
Exactly. Hopefully. They're trying to revitalize those areas. That's why you get benefits if you buy in those areas.
And there was qualifying things, right? It had to be, you couldn't just come in there and build, the JW Marriott in the middle of a low income area.
Exactly.
They wanted you to come in and build certain types of projects. When I say project, I don't mean projects as in project housing, certain types of building projects.
That make the most sense for the area.
Make the most sense for the area.
Exactly.
Right? That's good. Man, you are a genius, bro.
No, thank you,
This is a lot. This is like, I just want to say that we've been pumping stuff into one ear, right? And I know that stuff from the first part already kind of fell out the other ear.
Sure.
So that's why I recommend after you watch this, maybe you feel a little bit overwhelmed. You should feel overwhelmed enough to contact a CPA.
There you go. Literally.
A CPA that will help you plan. Now tell me about planning. When should somebody be looking at
That's
this?
A great question.
Yeah.
So right now we're in May. This is one of the best times of the year. So the best time, it's like asking you, if we're going to take a road trip from Tampa, Florida to Seattle, Washington, when's the best time to get directions?
Well, before you go.
Before you go, exactly.
Yeah.
Well, imagine your business is the vehicle, and the road trip is like from January through December. What most people do is they drive there all the way to Seattle, then they ask their accountant, what's the best way I could have come to get here?
In the following February.
Exactly. Yeah. Where the trip is already made.
Yeah, you already made the trip.
Right.
Yeah, why would you ask me now?
Exactly. Now, right here, this is May. You're almost halfway, a little shorter than halfway there.
Yeah.
There's still enough course correction where you can have still a lot of time and financial savings.
Right.
Does that make sense?
And depending on your income situation, there's things you can just do quick, which are easy to do. And in other situations where, hey, look, you weren't going to get the 100% of the benefit, but you'll get 75% of it now that you've corrected it this point of the year. Yeah, I got that.
But for the most part, though, believe it or not, this is enough time to get 100% of most things.
Yeah.
You just need time to implement.
Well, I just mean like there's some people that say, okay, well, we're going to fund an IRA. And for some people, it's like, okay, here's the money.
Right.
Other people, it's like, well, no, I need to do $500 a month.
Oh, I understand.
You know what I'm saying?
Exactly.
But depending on what their income situation is, will depend on when they need to make sure they're implementing these things. It's always good to be starting from January, right?
I agree.
Makes sense. So, bro, where are you from? Like, how did you learn all this?
Yeah.
Obviously,
I love that. I'm from Austin, Texas.
Austin, Texas.
Yeah, and I actually learned this in college.
Okay.
So my junior year of college, my tax professor said, hey, the IRS is looking for volunteers. It was called a Volunteer Income Tax Assistance Program.
Okay.
And if you go volunteer with the IRS, I'll also give you extra credit. And I'm like, hey, I'm in. I'll do it. Yeah, and I actually had the opportunity.
Volunteer with the government.
Literally.
Other than what he did, I don't ever recommend anybody do that. He did it to learn, right? Like, that's free education.
Yeah, I did.
I mean, you got to see the belly of the beast.
I did. I initially did it for the extra credit and to learn.
Sure.
But then, so what we did is we helped low to moderate income families. We prepared their taxes for free.
Oh, that's awesome.
So the feeling you got from helping people,
sure.
They say it's better to give than receive.
Yep.
Honestly, it made me feel so great that I just kept helping more people. So I'd help my friends, and then those friends would tell people, and before you know it, I had friends of friends I'd never even met. I'm doing all their taxes.
Wow, yeah.
And before you know it, I look up and I had
a CPA firm.
Yeah, exactly.
Yeah.
Exactly. I probably had about 40 people I was doing their taxes for free for. And I was married. I got married my senior year in college. My wife was like, if you're taking all this time away, you need to at least start charging.
Yeah.
And so I was like, okay, I guess that's a good point. And so I just started charging. But in the meanwhile, I'm still working in corporate America. So I was an accountant at Dell, and then I was I was there for about 2.5 years. Then I did accounting at Apple, a corporate account, like a revenue accounting.
Okay.
For about 7.5 years in my accounting departments. All the while, every season, I'm helping people with their taxes. And before you know it, I look up, I have a little bit over 200 people, close to 250 clients.
Wow.
While I'm in corporate America, tax season is coming up. And at this time, we have children.
Yeah, you're like,
3 children.
The gravy train's over.
Exactly.
Yeah.
So like, I just made a decision.
Word.
I was like, okay, well, I either need to go out on my own or I need to let my clients go and focus on corporate America.
Yeah.
I chose to go out on my own because I felt,
Good choice.
yeah, I'm grateful
Looking
for that.
back, right?
Yeah, definitely grateful for that.
Yeah.
Grateful for that. And so so this is my 18th tax season, counting all the way from when I first got started with the IRS and still been helping people this entire time. So,
Wow, man.
Yeah.
And so now, you went from just doing, taxes for free to teaching people how to make wealth by taxes.
Yeah, literally.
Literally.
That's the name of the company, Wealth by Taxes. It's
Yeah.
like,
Now, you wrote a book too, right?
I did.
What's the book?
It's called Profit Without Worry. So
Profit
this is
Without Worry.
Exactly. It's like a successful entrepreneur's guide
Okay.
to how to make more money, but not have to worry about a big tax bill later. Because that's what most people I know that are making good money, they're like, you know what? Business is good, but I just got my first tax bill with this kind of money and it stings.
I know exactly how that feels. And I can tell you, like, even, from experience going to the tax professional, even call it October before we hit the end of the year,
Right.
and then being like, hey bro, I'm not telling you to slow down, but,
Right, exactly.
And it's one of those situations where, ahead of time, the previous October, we had this expectation of what income was going to be like, and praise God, the Lord blesses you,
Right.
you get a lot of business, you get a lot of income. But then what happens is you run into this issue where your strategy that you set up previous October, kind of like you were saying, you should have talked to the guy in May.
Exactly.
Set up a different type of withholding scenario.
Exactly.
And that way, you would have been in a better situation come October, come tax time the next year where you're not writing a big fat check.
Exactly.
And that you've already withheld what you need to withhold or whatever. And I know that from experience.
Yeah.
Right? So I'm telling you from experience that it is well, and I'll tell you this too. This one's for free. I would normally charge $19.95 for this one, right? But I'll get this one for free.
All right.
Is that you can remit payments through vouchers to the IRS.
Yes.
Quarterly. You can also go online and remit payments to the IRS quarterly. And it's not really quarterly. They say quarterly, but I found out the schedule's all whacked out. And anytime the government gets involved with anything, it's weird. It just is what it is. But what I did find is that you could take that W-2 income that you get from your S Corp and you just turn it over to the IRS, a big portion or all of it, depending on what you're anticipating.
Sure.
And then the checks you write are to yourself. And I personally like a check with my name on it.
That's
a lot
good.
more than I like a check with the Internal Revenue Service's
For
name
sure.
on it.
Absolutely.
And that's just for your mental health,
That's
that's
good.
why I said it costs $19.95.
That's good.
Just
That's
enough
good.
to turn it over.
And can I add to that?
Please.
So you're exactly right. Now, paying yourself a W-2 income is going to be paying into the IRS, and that's golden.
Yeah.
But technically, to avoid something called underpayment penalty,
Right.
You need to be paying at least 90% of your, at least 100% of your last year's income or 90% of your current year's on-pace income.
When you say income, you mean tax burden.
Excuse me, yeah, 100% of your
Tax
previous
burden.
year income tax.
Got
burden.
it. So if I paid $50,000 last year, I need to then at least put in $50,000 this year to prevent a penalty.
$12,500 a quarter, yes.
Okay, yeah, look at you.
Yeah, for
Got
sure.
it. Okay, all right. Yeah, man. It's funny because that's what we were talking about kind of halfway through this conversation. We talked about sales tax and payroll taxes, how the government's like, oh, you holding on to our money.
Yeah, exactly.
They already see it as their money.
Literally.
And if you didn't pay it fast enough, they're going to charge you a penalty.
Exactly.
You're like, bro, it's not even tax season yet. What is
Right.
this? Yeah.
Now, and then this is where you get to where you can actually have options, Ryan. You can say, hey, I'm going to pay the government quarterly. But if you decide to use cost segregation, which you can actually use cost segregation, you can decide that right before you file your taxes.
Right.
Yeah. So you actually have
Even
time.
in the following year.
Exactly.
As long as you bought the property in the previous year?
Well, as long as you bought the property in the previous year, one, and then secondly, meet the either the active
Qualification.
participation
Got it, yeah.
or the real estate professional status.
Yeah.
As long as those three, if you bought the property, like the biggest things, you want to keep a logbook, by the way. Just documenting the real estate professional real estate activities.
Mileage deductions, people don't even keep those
Exactly.
logs. And it's important. There's apps and stuff that'll do all that stuff for you now.
Mile
Technology
IQ.
is like made it. There you go, Mile IQ. There's an app that you can use. If you're driving around and you're selling payment processing services and you're hitting up, businesses, merchants and whatnot, get Mile IQ and you could save on your taxes because, well, you can have profit without worry, like his book says.
There you
right?
go.
Where because I know you're already writing off the mileage.
That's it.
Right?
Yeah,
Facts.
for sure.
But you may not have a way to prove it because you may have written it down one number here and there, right?
That's right.
And you're going to get yourself in trouble if you ever get audited. However, if you use something like Mile IQ, at least you have that Mile IQ.
Absolutely.
Right.
You have that documentation, the first thing we were talking about. May I have one more thing?
Please, man, please.
By
You're
the
dropping
way,
the truth bombs on us, man.
Awesome, man. Awesome. If you have a corporate structure, a corporate entity that you're filing taxes on, you're 10 times less likely to be audited than if you're filing taxes as a sole proprietor on your 1040 tax return.
Like a Schedule C, right?
Correct.
Yeah, okay.
A Schedule C is one of the most audited. It's one of the forms that causes an audit for most people, and it's mostly because that's one of the most abused forms on the tax return.
Yeah.
If people are...
That's because TurboTax is producing those things for people just like, they're double claiming deductions and stuff like that.
Absolutely, it's that, and plus sometimes people aren't fully reading the prompts or they have a misinterpretation of what TurboTax is asking them.
Well, that's what I mean.
Yeah.
Which is why they should use a professional.
I agree.
Yeah.
Especially if if it's a side hustle, maybe you made like $10,000, $15,000 a year, you might be okay.
Yeah, listen, $10,000, $15,000. I'm glad you made the $10,000, $15,000, and that's great.
Right.
But when you can pay an extra few $100s for the tax preparation to save you from having the IRS come back and take all $15,000 of those dollars back.
Yeah.
You know what I mean?
Yeah.
Because in just the heartache and the having to prep forms and the taking away from what you would normally be doing in your time and energy and all that, it's just not worth it. Right?
I agree with you.
And so tell me, your book, Profit Without Worry, is available on where?
On Amazon.
Okay, so they can get it on Amazon. All right, Charles Hopkins, Profit Without Worry. You want to get that book because it'll give you...
Oh yeah, you want to get that book because it's going to give you the game plan. It's going to just let you know that really the tax code is written for you to take advantage of it.
Yeah.
A lot of people get mad at, it's not fair for these people to not be paying taxes and to be making money. But truthfully, the IRS code is written for anyone who wants to take advantage of it. And that includes you, that includes you, that includes me, includes anyone that says, it's kind of like playing basketball. And it's like, hey, if you shoot behind the 3-point line, you'll get more points than if you shoot in front of the 3-point line.
That's right.
Right?
And nobody has a problem with that.
No. So if you shoot behind the line and you make it, you get more points. But those are the rules. So if you follow the rules.
I will also say this. I mean, paying taxes, right? Not for nothing. It's funny how I'm not saying I was never into politics because I've always liked politics to a certain extent.
Right.
But like it's different when you write a check to the U.S. government. It's got some zeros behind it.
Sure.
And you're like, you're doing that in my name with my money.
Right. Exactly.
Right? And when you also consider that like they waste a lot of money, right? You're like, I want to give these irresponsible people as little as I possibly legally can.
Literally.
And to that end, I would also say, don't do anything like sideways, because if you can't substantiate it and it's not something you can document, my opinion is pay the taxes.
Exactly.
Because again, you do not want...
It's profit without worry.
Profit without worry, exactly. You want to not worry about it.
Exactly.
Don't be looking over your shoulder like, oh God, I hope they don't find out about that one.
Yeah. I've been doing this a long time. I've literally done over thousands of returns myself.
Yeah.
Over 2,100 returns, me physically doing.
Yeah.
And one thing I've seen is that sometimes people are legally eligible for expenses, but they choose not to take it just because they're worried. And I realize peace of mind is more important than savings.
Yeah.
So like, if you do feel like, I'll do it anyway, like And it's gonna, like, you just don't want to be on edge for 3 years.
Yeah.
Because the IRS can come.
Yeah, 3 years.
Yeah.
That's a long time.
It's a long time.
That's right.
To be in fight or flight mode, like, hey, are they coming, or am I okay? Like, you don't want that burden.
You don't. No, I agree. I 100% agree, because I'm a peace of mind guy. You know
Right.
what I mean? I'd rather have peace. You know what I mean? And it's like, I've written checks for peace of mind in other situations.
Exactly.
Right? Just because I was like, the peace of mind to be able to move forward with the freedom is more important than that amount. Like, how much
Potential
money
savings.
can I how much money would it take to get that peace?
Exactly.
Like, you can put a number on that, praise God. If you can put a number on it, it's a number you have, that's a good day.
Exactly. I kind of see it like this. I'm sorry, I know.
No, you're good.
If the mafia had a briefcase with $100,000, it's like, yo, hold on to this money.
No,
but at any given moment, somebody could come looking for it. They may not, but they could.
Yeah.
Would you want to hold on to
No,
it?
Thanks.
That's what I'm saying.
Yeah.
Especially you don't want the IRS. So.
No way. Yeah, exactly. Well, and not for nothing, the government, every law that they have, right, that we have as a people, right, our government,
Right.
is always enforced at the end of a gun. Make no mistake. You owe the money to the IRS, they can't arrest you.
Yeah.
And the people that come to arrest you will be coming with guns.
I was wondering where you were
I just
going
said
with that.
Right. I just think, like, it's important that you know that there is a worst case scenario.
Right.
In these situations, probably won't happen to you, I'm sure, because you.
Can I say one more thing to that?
Yeah.
Intent is everything. So it's all about intention. Is your intent to defraud the IRS? If so, but if you literally just made a mistake, they'll work with you on fixing it.
Yeah.
There may be fees and penalties and interest, but they'll work. So they're not going to throw you in jail for a mistake,
Sure.
or if you misunderstood.
Got it.
But you're right. If your intention is to defraud the IRS, yeah.
Okay, so cool. So you work mostly with entrepreneurs, all types of different
Absolutely.
business owners.
Absolutely.
In what states?
As a licensed enrolled agent, I actually can practice in all 50 states.
Okay, so really anybody in the United States that's watching this right now, they could literally have you as their CPA.
That's correct.
That's amazing.
Yeah, absolutely. So the biggest thing,
Because it's one thing to like you and like your information. It's another thing to be able to be like, hey, Charles,
can you
do
help
my
me?
taxes?
Yeah, exactly.
Right.
Exactly. If you're a successful business owner, you're making a profit.
Yeah.
Because if you're already at a loss and you're not paying any taxes, none of these strategies, if you're not paying any taxes anyway, it's not going to do anything for you.
Sure. But if they are making a profit and they felt the burn, maybe a little bit, or they're worried they're going to feel the burn,
Right.
then that'd be somebody that should reach out
That's
to you.
exactly a great point. If
So you got a book that they can read and learn.
Correct.
You got this podcast, which maybe we're gonna have to put this behind a paywall, right? We probably won't, but
it's close. It's close to
we're right there. This is
sure.
the money right here. Or they can reach out to you directly. What do you have, a website they can reach out to you on?
I do.
What's that?
So it's wealthbytaxes.com.
Okay, perfect.
Yeah.
That's just like it sounds. Wealthbytaxes.com. They can reach out to you. That's good. All right, man. Well, man, thanks for being here, bro.
Yeah,
I
it's my
appreciate
pleasure,
you.
Ryan. Thank you, man.
Yeah. All right, guys, you heard it here. This is awesome. I can't believe that we're going to save so much money on taxes. If you knew how much I paid in taxes last year and how much he was telling me that I could have saved if I would have just done a few of the things that we talked about today in this episode, then you would be poking fun of me right now, because I'm poking fun at myself a little bit. But as I always tell you guys, success on repeat is all about taking these things, taking action on them, because you can repeat the success that he's had, that his clients have had, that I have had, that our clients have had, by just doing the work, putting one foot in front of the other, and taking the actions. And so go ahead and get your success, put it on repeat, and I'll see you on the next one.